Today, in this special edition of On Point by Oak Street Funding, we're going to be discussing the latest news on tariffs. We will be discussing the ongoing economic uncertainties, the effects on insurance and investment advisors, and more. I'm Matt Staninger, Market Research Analyst here at Oak Street Funding, and joining me today is Mark Chandler, Managing Director and Chief Market Strategist of Bannockburn Global Forex. Mark, thank you for being here today.
It's going to be an interesting discussion given these times.
Right, lots of times of uncertainty and lots of times of unpredictability. Let's first talk a little bit about the latest of what's going on with tariffs. At this point, there have been a couple of deals that have been made as we're approaching and right on that July 9th target point of where we are going to see some further discussions on changes for tariffs. Ongoing right now as well, many letters are being sent out to various countries as Trump has tagged that he has not been able to have person-to-person negotiations with 200 countries all at once, so he wanted a more generalized way of doing this. Some of the letters already sent include a 25% tariff that is being announced on South Korea, as well as a 25% tariff on Japan. We expect more letters to be ongoing to other countries as well. There's also wide thoughts that these tariffs will take effect on August 1st, giving just a few more weeks for negotiating time. And one special area that we are expecting higher tariffs on is a 50% tariff announcement on copper, as well as a 200% tariff announcement on pharmaceuticals.
It's what a world we live in. I mean, these tariff levels, even if these go through as planned or as suggested in the on Liberation Day in early April, the average U.S. tariff is going to be higher than Smoot-Hawley tariffs before the Great Depression. And I think this just strikes me as sort of where we are in the world, that the U.S. created after World War II, created a multilateral free trade oriented system. And now the U.S. has defected from it. And not just to the countries that you mentioned, but you cited the U.S., Canada, Mexico free trade agreement. The U.S. has free trade agreements with South Korea as well as Australia. And yet that doesn't seem to have stopped the U.S. from going forward with these higher tariffs.
Right, and we'll see ultimately where these land. They continue to change. Many of the letters going out show slight changes from what the April announcements originally were. We'll also see what the courts decide is legal without congressional approval as well.
I think, Matt, you raised a good point, too. I mean, the two things that occur to me. One is that at the very cornerstone of free trade is what we call MFN, Most Favored Nation status. And this is at the cornerstone of both the GATT and its successor, the World Trade Organization. And the essence of it is that countries should not discriminate against other countries. That is, if we're going to charge one country X% tariff on autos, we should charge all countries at same level. And what the Trump administration's introduced, it really comes at the core of free trade by really violating this most favored nation status essence of free trade. And the second issue that you raise is important too, and that is that a lot of these broad tariffs, not the sectoral tariff like you mentioned as semiconductors, pharmaceuticals, copper, steel, these were done under a separate authority. But the broad tariffs, these reciprocal tariffs, are being done under an emergency powers authority. And in late May, a U.S. trade court ruled them illegal. And a appeals court gave a temporary stay, and that case will be argued again in late July. So the legal status of what's going on is still a little bit unclear, and which is why I think some countries are holding back, thinking that the U.S. alone, the U.S. courts might alone sabotage or undermine these broad sweeping tariffs, like you mentioned, without really Congress taking action at all.
Those are very great points there, and talking about some of the conditional pieces of among the most favored nations, among some other unfair practices that could be viewed potentially by the courts later this month. That brings a lot of uncertainty. Really, uncertainty is what we're seeing in a lot of other economic areas as well. We recently had the FOMC meeting. What we really saw with that was some of the impacts that tariffs are bringing. We're expecting to see some near-term increases in inflation up to about a 3.0% level by the end of 2025. We're also expecting to see some decline in GDP in the near term, down a few tenths of a percent from what the March expectations were for 2025. However, whenever we look at the longer run, that's virtually unchanged, which really shows a lot of uncertainty there.
I think they're right, man. What strikes me about the FOMC and that the latest summary of economic projections is that the median forecast for the end of the year still talked about 2 rate cuts. But to your point about the uncertainty, what happens is around that median, it created that greater divergence, greater disparity among the different members. It sort of reminds me of that story about a person who's got their head in the oven and their feet in the freezer, but their average temperature is fine. And I think that's really what happened. The extremes. I mean, out of the Fed officials, almost half of them were looking for no change to maybe 1 cut this year, while others were talking about as much as 3 cuts. The market is settling down now around 2 cuts this year, but even that's not a guarantee in the market's mind.
Specifically for insurance, one area that we could see is higher costs due to the tariffs taking effect on materials. At this point, there is seen excess supply in many materials that was predated before the April tariffs had officially taken effect. However, those supplies are going to continue to cut down. We saw capital expenditures at their lowest point in the last 5 years here recently, showing that small businesses are spending less at this point in time.
Yeah, man, what we're seeing too with small businesses is that, when the dollar was strong and rising, foreigners would be happy to take U.S. dollars for payments for what the U.S. was importing. Now, with the dollar falling, and in fact falling sharply, among the worst periods we've had in the dollar in a couple of decades, that foreign businesses now want the U.S. companies to increasingly pay in their currency. They don't want the dollar. The dollar's become a depreciating asset. So this may require small U.S. businesses to rethink about their currency exposures. Previously, they were able to pay their suppliers in dollars. Now those suppliers want other currencies, their currency. But also to your point about imports, what we're seeing, even though the administration is saying that there's no import inflation, here's what it looks like with the government's data. Import prices, excluding petroleum, and we'll exclude petroleum just because it's sort of a unique market, and the U.S. is so reliant on its own energy supplies right now. But in the Q1, the import prices rose by about 0.1%. That's just a sum of the 3 months in Q1. We don't have the June data yet, but in April and May, import prices rose by a combined 0.6%. And some companies, of course, we see this in some companies, Japanese auto companies, for example, seem to have been willing to accept a very small increase in prices, and they are eating the tariffs by having a smaller profit margin. However, as the tariffs stay in place and maybe even go up, the risk is that more businesses pass on those costs to the U.S. consumer. So U.S. businesses, foreign businesses might at first take that narrower profit margins, but over time we expect those costs to be passed on to the consumer, which is why the Federal Reserve has said, Chairman Powell has been very clear, that if it were not for the tariffs and the inflation expectations contained in them, that the Federal Reserve would likely have resumed its rate cuts that began last year.
Which brings a really good point for really 2 different areas for insurance agents to focus on. Costs of materials are likely going to be rising, which means cost of claims are likely going to be rising. At the same time, because of inflationary pressures on clients, what we could be seeing is some areas of coverage that are seen as less necessary, those may end up getting dissolved, creating some pressure on their books. Now, as we go over to the investment advisor side, we're going to continue to see volatility in the market as predictions are broadening in that wider range of what we could expect for possibilities. So there's that uncertainty existing there. And of course, specifically with RIAs, having the fiduciary duty of making sure that the client's best interests are in mind, they are required to act on that as that's happening. So there will be a high need for continued closeness to these kind of topics.
And I think this is like a big challenge. We had a big sell-off in April in the stock market, and many people gave up. And then the markets rebounded strongly with the S&P and NASDAQ making new highs. And I think that this sort of forced, especially retail investors, back into the market. What concerns me is valuation is still stretched. And insiders, these are the corporate executives. They've been net sellers of stocks. So the insiders, what we think of as smart money, has been selling, even as retail has been buying. I think this is going to be a challenging period, especially if the U.S. economy weakens, like it looks like it will, especially in the second half of this year.
We have that general expectation for weakening, as you just mentioned, but that also creates some opportunity to be able to use the volatility, and especially with some of the foreign exchange rates, as you've mentioned, the weakening dollar. How could that potentially be taken advantage of by some of these investment advisors?
Yeah, I think that one of the things that we've been really trying to champion for over a year now, really, is that we thought the dollar was overvalued, U.S. assets overvalued. This is the time we've thought that U.S. domestic investors, we're still heavily weighted. Our employers tend to be American companies. We have our 401ks, our investments typically are in U.S. companies. But this is the time to diversify. In the foreign exchange market, one of the reasons I really like it is that you don't have to have a lot of new ideas, in the sense that trends last a long time. We're just getting over a dollar bull trend that lasted from the early days of the great financial crisis. It was more than a decade old, and that dollar super cycle uptrend is over. And the dollar index, this basket that the dollar trades against the major currencies, is peaked in September of 2022. So we're well into a bear market for the dollar. And as the dollar falls, foreign assets, foreign currency denominated assets like European stocks, Asian stocks, foreign bonds are more attractive to dollar-based investors. If you have a basket of international stocks, the currency could be a third of your total return. And if you have a basket of international bonds, fixed income, the volatility is such that the currency component could be 2/3 of your return. So in this falling dollar environment, which I expect to continue, it makes sense to diversify into foreign assets.
Thank you so much, Mark, for being here to discuss tariffs with me today, and thank you to those watching. For more information and access to free resources, visit us at oakstreetfunding.com or call us directly at 866-625-3863 to start a conversation. Let us help you navigate the evolving lending environment and secure the capital you need to thrive. Thanks for joining us on Point.